Welcome to the Show Me the Money podcast, Unlocking Property Finance. Join us on an exciting journey into the world of property finance, where we uncover secrets, strategies, and opportunities that can turn your property dreams into a lucrative reality. Welcome to Show Me the Money, Unlocking Property Finance.
Hello, everybody. Welcome back to another episode of Show Me the Money. We're super excited today. We've got a fantastic guest, Louisa, who is one of the underwriters at Fiduciam. Obviously myself, Sharma, property investor and developer based in South London. And today, obviously as ever, co-hosted by Marc. Marc, just remind everybody of who you are and what you do, and then let's hand over to Louisa to tell us about herself.
Yeah, thanks, Rose. So, Marc Champ, Managing Director of Wolf Financial, property specialist brokerage based in Essex, but cover the whole of the UK. Also dabbling a little bit of property investment myself. Host the PPN in Brentwood, and also just launching the Professional Property Circle, which is going to be in London. So, yeah, fingers in a few pies.
Very much looking forward to that. So I was fortunate to have met Louisa a couple of times actually over in MIPIM, and obviously myself and Marc met out at MIPIM last year. But it was great to meet in person. I remember after having spent some time on a Zoom talking about potential collaborations and deals for myself as a borrower. But Louisa, welcome. Tell us about yourself. What's your background? How did you end up with Fiduciam? And tell us about what you do there.
Sure. Thank you so much. Thank you, first of all, for having me on the podcast. It's brilliant to join you, and opportunity to speak more about what we're up to at the moment and some of our experiences. So thank you. So I am a underwriter at Fiduciam, and really my background has been in small businesses. So I studied law and went into a variety of startups over the years, and all of that experience brought me to essentially what is looking at the risk of transactions from a lending perspective. So having gone from many years of looking for funding for various ventures, moving across to being on the funding side was really the transition that I made when I joined Fiduciam. We are a lender based in London that works on short-term facilities for bridging development. So we have quite a big scope ourselves anyway. And so I think my background tended to suit that, because I come from quite a general background where I then developed a lot of experience with developments, in particular my real estate understanding. So really that's kind of a very short intro. What I tend to focus on a lot is our Scottish transactions. I don't have a Scottish accent anymore, but that's where I grew up. And I think Fiduciam, although we're London-based, also has tried quite hard to really get out of the brand and really highlight the blend across the UK. So that's something I definitely want to speak about, is that although we do transactions in London, like every lender, we do spend a lot of time out and about, myself in Scotland, some of the rest of the team in the Midlands, Southwest. We really try and lend across the UK, and we see opportunities all across the country.
Fantastic.
Yeah.
And Fiduciam, tell us, because I know you've actually got a bit of a pan-European presence as well. So tell us a little bit about the organisation, the funding lines, and how that's structured, and what you do in the other geographies, because that's quite interesting to hear about also.
Yeah, absolutely. So Fiduciam has been around for around 10 years. And our co-founders have a European background, banking background. So we actually lend in the UK alongside Germany, the Netherlands, Spain. And then when we're looking at the kind of broader sense of UK, we also lend in Northern Ireland and the Republic of Ireland as well. So we have teams dedicated to those jurisdictions. We can do cross-jurisdictional transactions. And I think in particular in our early days, that was one of our USPs. Now, I think we're probably trying to highlight again that we do lend in the UK on much more traditional products as well. But it definitely helps us have a broader understanding of trends, of where different markets are going. And we all work in the same office in London. We have some parachute offices in the country as well. But it's great to have everyone in London sitting alongside, looking at different risk parameters, different transactions all across Europe.
Fantastic. And so for you as an underwriter, what are you seeing? What sort of trends are you seeing at the moment? What are you seeing more of in terms of the types of deals that borrowers, investors, and developers are bringing forward? And how has that changed over the last 18 months, say?
Sure. Yeah, well, I joined Fiduciam during COVID, so my takeaway mainly is that it's been such huge fundamental shifts over such short periods of time in the last 3 years. And in the last 18 months, we're seeing some of those shifts, ripple effects, still having large impacts. Obviously, we'll all have seen the change in costs initially, war in Ukraine, etc., having that impact directly on, in particular, development finance. But then in the last 6 months and a year, we've seen that huge shift politically, producing the inflation, the change in rates. And I think that we see those big impacts have ripples that last a lot longer than maybe people expect. So be it the change in rates or the change in construction costs. Construction costs, we're now seeing people using the contingency now that was caused by the change of costs a year ago. So I think as an underwriter, a lot of it is looking at trends that were happening and making sure we're considering them a year or two down the line as well, not just that immediate reaction that is much easier to see, because to be reactionary, you can take an immediate view. If you're coming up for completion on something now, you can say, okay, well, what's happening in the next 3 months very easily. It's looking at what those ripple effects down the line are going to be. And I'm sure I'll talk about it later in terms of what really helps us when we see a good borrower and a good transaction. A lot of that is looking at worst case scenarios, contingencies, track record and expectations, and really looking at those things and seeing if we all align. And for me as an underwriter, looking at the trends that are happening, that's one of the biggest things I'm looking for, is that longer term view. Even though we're a short term lender, is that things happening in 2 years' time just as important. So in terms of trends, yeah, we're seeing a bit more auction finance coming through, that again people may have started looking at a year ago as something that was going to be coming through with the cost of living crisis or some distressed assets. I'd say we're only really starting to see that now, and that obviously has its implications at the other end, that we're seeing some kind of real squeezes on construction. We're seeing some real squeezes on projects that maybe weren't fully funded or hadn't considered that cost implication a year down the line. So both on opportunity and negatives, we've seen auction finance being something we're seeing more of. We're also seeing people scaling up slower, looking at good developers. They're not looking for huge margins, a huge turnaround, or very ambitious planning changes, projects. They're seeing small incremental increases on their own track record. And that's really positive for us, because I think that's a very strong sign of where you're going to get sustainable growth in a difficult period of economic landscape.
So I've listened to what you've said, and I tend to agree with virtually all of it. The one thing that I've seen as a broker has been the events that are happening more often. So there's more ripples that are created, maybe not quite as big as, say, credit crunch or anything like that, but there are more of them, and they have a still a long-lasting effect. I presume as an underwriter, you have to take that into account when you're assessing developments, and that will really give you an idea of what's going to happen in the future, because you're prepared for these extra ripples in the market that we didn't used to see. Would you agree?
Yeah, yes and no is probably the better answer. It's yes, in that we will building in contingencies, be it something the borrowers approached us with as an existing contingency, or where we said actually we'd like an additional contingency. It's very specific, obviously, to build costs. Because we've seen in the last 12 months people utilising their contingency. So therefore, where it would have been a 5% contingency before, saying actually we'd be looking at closer to 10%. So yes, that would be where we're looking at all of the ripples colliding and saying, this is what we think you're going to need to utilise in a year's time, in 18 months' time. Some things I would say we see changing expectedly. We have a very different rental market now compared to 3 years ago, and where properties were potentially going to be exiting via sale. Actually, once the buy-to-let mortgages are available and in place, people are making huge returns on rental units, in particular in the southeast, which maybe we wouldn't have foreseen 2 or 3 years ago, because we didn't see that huge increase in mortgage prices stopping people progressing through the property ladder, looking at a rental alternative. And for good sized units in, say, London, that's a huge kind of market emerging now that's come a ripple we weren't necessarily expecting.
Okay, so if the rental market is stronger and we're seeing higher rents, are you, as an underwriter, allowing there to be a lower profit on cost in the schemes than, say, 3-4 years ago?
I wouldn't say it's necessarily allowing. I think it's taking into consideration that where a few years ago, simply flipping a property, doing a small amount of work, maybe a planning variation, was leading to these big profit margins. Actually, we might not expect huge profit margins to be achievable on a pure kind of sale basis. So again, I think the biggest thing as an underwriter is looking for, we always say, it's risk checking. It's looking to see where are we comfortable. You're looking at the worst case scenario. As Fiduciam, actually, we didn't really speak about our funding, but we have a mixture of institutional investors, and then Fiduciam ourselves put money into every transaction. So flipping that question on its head and saying, okay, if you were a developer approaching us, if you were one of our investors or just ourselves, are we happy that we're putting in money into something that has a realistic outcome to it? And margins is one of those parameters. Is it a realistic margin? If we see huge forecasts, we might question it more than if we're seeing neater, more realistic forecasts in the future.
And you used the word risk in there, and I remember when I was a lender, I went in and I was surprised how the underwriters in the particular lender weren't looking at stuff on a risk-based approach. It was more a checklist. I presume you guys, being more specialists, in my opinion, are looking at risks and mitigating circumstances than a checklist.
Yeah, absolutely. And I think that's something I get fed back by borrowers a lot, is that everyone says it's case by case basis, but we are we have a very thorough underwriting process. We all try and get very in-depth in the deal quite early. It's always good to know what's going on behind the scenes as quickly as possible, because you can give much more thorough answers, questions early on in the transaction. So yes, our specialist style leads to probably a much greater information flow, but hopefully also a greater communication level than, say, in some lenders where, as you say, it's a checklist, it's quite formulaic. Your value is X, therefore your loan is Y, and this is our interest rate. We're much more bespoke than that. And as an underwriter, I'm on site a lot, and that often surprises people, especially where we've got transactions at the moment with modern methods of construction. I want to complement my own underwriting by being on site. If I see my first site of that style through to my 5th site, every single one I'm going to learn from, alongside being able to give better risk feedback to ourselves as a lender, and be able to make, as you said earlier, judgment calls on what we should be expecting down the line.
I see. Very good. It's so interesting seeing how different lenders and different underwriters, even within lenders, approach things. It's sometimes we ask for a particular underwriter in a lender because we know they understand things, whereas usually it's the less experienced ones don't understand or won't take into account mitigating factors, and it can become quite frustrating. So it
Well,
is very encouraging to hear of the approach you guys have.
yeah, and there'll always be fundamentals. Track record, I think, really is, as I said earlier, in times that are more difficult, times that are, we see huge amounts of difficulty getting through planning. Where you're building on a track record that is strong and you're scaling and adapting your builds in a natural progression. I often see that's where you're getting planning variations and things not happening necessarily quicker, because I think that's a whole other topic, but it's something where you're using your own experience to take on your next project. And we as a lender see that being very beneficial. And
I think that point you made about incremental and scalable growth that you're seeing more of, the more considered approaches with developers, it makes sense, because it is much riskier out there for all the reasons that you've described.
absolutely,
Makes complete sense.
Also on which professionals you use, be it as a developer using contractors, QSs, architects, but also just even if it's just an acquisition, the solicitor you choose to use, if they are very good at knowing exactly what type of transaction on property you're looking at, if you work well together, you communicate well, as a lender, that can make a huge difference to us, not only because we can see that flow of information is very clear, but also because it will keep momentum behind transactions. A lot of developers and borrowers ask us, why can one deal go very quickly and one go slowly? Often it all comes down to communication, and that great team of professionals behind you is a huge part of that. And as I say, it can be the solicitor. If you've got a solicitor that potentially did an acquisition with you, went through the properties, searches, titles, all this detail, once they'll have a pack ready to go when you then go to a lender. And all of that working simultaneously is a complete godsend to a lender. And in terms of, I think we spoke previously that we talk a bit about how developers can be more prepared for the lending environment. Part of that is having all of those professionals ready to go, well versed in what type of thing you do, and have that information flow really clear.
Makes perfect sense. We've actually had a couple of solicitors on previous episodes as well, where we talk about things they can do to improve communications also, but it's a fundamental point, because that's where things always go wrong. So it's great to hear that from you as well. Are you seeing, just a quick question on the types of projects that you're seeing then. I mean, obviously we've discussed how rents have actually been far more attractive over the last sort of 12 to 18 months, and how that has altered the exits for some of your borrowers. Would you say that there's been more sort of flexibility in terms of the type of exits they're looking at, or would you say you're seeing more developers who are looking to build schemes out to retain, or are they just kind of keeping both options open? Because I guess whichever option you take is going to require a slightly different approach in terms of how you structure the deal and perhaps the underwriting that you do as well.
Yeah, I think that we haven't necessarily seen all these changes come to fruition yet, but I'd say you're completely right. We would look at both options, where previously the developer might have said, I'm developing 9 units and I'm planning on selling all of them. We might strength test the exit against partial sale, partial retention. Or we might strength test, what buy-to-let mortgages will be available at the end of the term if actually you change your mind and you would prefer to retain things. So we can always stand with the plan A exit. We'll do all of our calculations against that. Really, that is the fundamental. But we'll always look now. Well, we always would have done anyway, but we'll probably put a bit more weight on plan B, plan C. Because plan B may become plan A, and we're very aware of them. Where we've seen bigger differences is maybe the types of deals that we're seeing in different regions. So, for example, as I said, I do a lot in Scotland. there are huge licensing changes happening in, say, Edinburgh around short-term rentals. So where property could have been an Airbnb previously, now there's much stronger regulation around that. So in Edinburgh in particular, but in Scotland more broadly, we're seeing a lot of apart hotels. So they're semi-commercial properties. They're being developed specifically to be short-term rentals and with either owner-operated or put onto arm's-length leases. And that's something where we've done a lot of learning over the last 2 years to really understand that market, really understand the multipliers we should be expecting to see there in a market that itself is changing because of new regulation. So that's been a really interesting change that we've seen. And it's been an opportunity for developers in that region that are ready to take on those types of properties. But it's also meant that where someone may have looked at an Airbnb option or a short-term rental option previously, actually they're now not going to. They're probably going to do a residential sale because the regulation's changed.
We're seeing more. Yeah, sorry, go on, Ray.
No, I was going to say, I think you were going to say the same thing. You're probably seeing more interest in service accommodation, but we're also going to see a lot more regulation in that space across England as well, especially with the new use class and the registration requirements as well.
Yeah, that's what I was going to say. We're seeing a market increase on this service accommodation and holiday lets, and there aren't that many lenders who will do that on the exit. So West One will do. There's a couple of building societies that will, but other than that, the Shawbrook will, but it's not that easy to get through. So it's hard to get that. And when they're valuing it on the exit, they're only doing it on the AST income anyway. So it doesn't really matter if it's service accommodation, holiday let. You still need the AST income to get the numbers to stack up.
Yeah, absolutely. And I think something that's often a difficult conversation with borrowers on the development side when you've got something that's going to be something slightly more commercial is that vacant possession angle as well, the bricks and mortar values that can sometimes be just a much lower number than expectations. You know, if you're doing something that's trading, you always want to think about those multipliers on income, but lenders will also always look at that vacant value, and it's not trying to be detrimental to the business plan, but it's how we again will look at another version of risk, another worst case scenario. And I think borrowers being prepared for what their vacant property is worth is also a great thing just to have in mind in the background, and knowing and asking early on of your lender, do you have any parameters based around vacant figures? Again, if you're buying at auction, you know, you're looking at the vacant possession value. Often you're starting from a very low number compared to potentially what the market value is. It's been tested in the most kind of pure market there is. Whereas if you're looking at something trading or an existing trading property that you're looking to acquire, there are various figures in the background that lenders will look at. That it's great to have a bit of an understanding of before you jump. How
about for HMOs? When would you look at it as a commercial valuation, or would you not ever look at it as a commercial valuation on the exit?
No, it's a very good question, because we definitely see two different types of HMOs in particular. We see student housing and we see some social housing. We will very much look at the strength of the covenant. If it's, for example, a tenanted property, I've looked at ones down the line in the past where the council's been a direct tenant, but we then look at the strength of the council. So as a lender, you've got lots of different parameters there. You would look at those trading values, you would look at the returns that are there, but you also, if it's trading already, you need to look at the strengths of current trading. How strong is it in terms of returns and interest coverage, but also, is it going to be there in a year's time? Is it, you strength test that actual tenant, that lease? With HMOs that are more targeted at students, often are going to be run directly by the developer post completion. We will look more at the market, student housing in that city, that region. Is it in lots of regions currently have a huge undersupply, so we can see that the market maybe is going to be adjusting pricing upwards, and we can keep that in consideration. But we'll also look at areas where we see student housing might have regulation changes coming up, anything like that might suddenly fall away. From my own experience, some cities can put in districts that they want to focus student housing. They want to give other areas back to more residential focus. So you want to be balancing all of these moving parts. And HMOs, as I said, it's an interesting, very specific sector of housing that has both its own blessings and curses sometimes. But yeah, we'd look at the broader picture for the region specifically. We'd look at any regulation. We'd look at any income generating that relies on a third party. So if there's a middle tenant or a kind of operator, we do look at the strength of that. And again, we'll always look at the bricks and mortar value of the property or any alternative uses. So could it go back into pure resi? If not, why not? Who else would take on it?
Makes sense. I've got a question for you. So as an underwriter, you've obviously got to have great investigative and analytical skills, being able to research all the different areas you need to do, for your due diligence. What sort of tools or platforms, if any, do you use as standard? Obviously, there's a lot of good old Googling involved, but are there any other sort of platforms or third-party services you typically rely on to help us understand what goes on behind the scenes?
Sure. Well, Fiduciam ourselves, our brilliant IT team have created something we call our loan builder, which is software that we use directly alongside borrowers to collate information. And that has various plugins and so on to CreditSafe or other kind of third parties that can help produce information in a really simple to access way. And I know Marc, as a broker as well, that information flow between borrower to lender, if we can keep it all paperless, we find that it's so much easier for people to be providing information quickly, and that gives us a one-stop shop for all of our borrower information. So that piece of software is completely vital to us, but that is something that we've developed ourselves. In terms of the broader searches, I mean, you can go through so many different softwares for property comparisons, but we find looking at our recent valuation reports from all of our valuers, picking up the phone to valuers, picking up the phone to estate agents, and looking at recent marketing on Rightmove, any price reductions, that gives you, we're happy to put that bit of work in. So we often will really lean back on the information that we've had recently coming in from our own instructions, from our own recent completions, or actually really I often look back at a property that we maybe funded development of or didn't lend on a year before and look at how it's performing now. So actually I'd say we don't tend to use that many complete kind of third-party information providers, especially on the property side. We use our own information, something that we've got a particular read on. As I said earlier, I'll have learned from my previous transactions a huge amount, and that doesn't just stop when the loan completes or when the loan is declined. I was looking at a commercial transaction this morning that we didn't lend on for various reasons 2 years ago, and now I can look back on it and see what's happening to it now. And I think, returning back to the question earlier, how do we make decisions now based on records we've seen previously in their crossover? That is a huge source of information. It's looking what happened to that project, what happened to that property, and so that kind of side of things, we use a huge variety of different things, but not necessarily a specific software.
Yeah. And How many deals will you look at on a typical day?
Oh, great question. Completely changes. Monday's very different from Friday. Everyone sends us stuff on Fridays, so lots on Fridays.
Do you know, that does follow in from what we get as brokers. Mainly Fridays is the busiest day for new inquiries. So that's probably, when we're pinging it all off.
Yeah, really. On Fridays, not only do the new inquiries land, but probably the valuation report and the QS report too.
Yeah.
Everyone's cleared their inbox.
I know, the valuers love putting them in on Friday, so you can't chase them over the weekend. Let everybody cool down a little bit.
So I'd say it does change, and it changes through the year. I'd like to be looking at least 5 deals in underwriting at a time. As Fiduciam, I mean, every lender has different terminology. Fiduciam, we'd say you have inquiries, you have underwriting transactions, and you have pre-completion transactions. So in underwriting, I'd at least like to be looking at 5 simultaneously, be that at various stages of the valuation coming back, QS, compliance, wherever that be. That would be probably my base level, looking at 5. We were a Steebles lender, which was a brilliant opportunity to look at hundreds of transactions during COVID. At that time, we would be looking at a much higher volume of transactions, simply because there were a limited number of Steebles lenders. And it was an amazing opportunity. If I had been a borrower developer, then you'd be looking at all of your projects and seeing if there's any that were eligible for a Steebles loan, and it was a great experience underwriting those types of transactions. And you'll also get quite a lot where we can see the seasonality of, say, planning applications clearly being a bit approved. We'll get a lot of new transactions coming through where clearly there's been a bit of a spate of planning coming through. People are ready to kickstart, get the development finance in place and start builds. Something it applies across the UK, but I definitely see it in Scotland, the seasonality of the weather making a difference to when people want their especially development starts to be taking place. I've had quite a few transactions that I started working on in January, February, really to line up funding starting to come out in spring, and looking at a kind of 6-month build period from that point on.
I've got another question, actually. That's very, very insightful. You talked about how, as part of your preparation, especially when you're looking at the rental exit, so not every developer is looking to sell. Sometimes they have no choice but to keep hold of it, even though they're wanting to sell. But with a strong rental market, obviously that's good opportunities, as we've discussed. But when you are assessing deals that are actually going to be retained, perhaps on the outset, how do you assess what the market outlook is going to be like for the term lending? Because presumably you work closely with or have relationships with some of the sort of long-term mortgage lenders. I know you've got quite a diverse team there at Fiduciam. Some of them actually come from some of those long-term lending organisations as well. But how do you, other than looking at a lot of the sort of economic forecasts, what else do you do to try and ascertain what an exit might look like on a term product?
So, I mean, as you say, we'll take a look at the long-term forecasts, but really it's looking at a huge range of lenders, going through looking at what their appetite would be at that time, because some lenders will be reflecting what other lenders would be doing in a year's time. If you've got really conservative lenders in the next rung down, are they going to be following on behind, essentially? I wouldn't say that there's a huge kind of tactic as such. It's just getting a very good read of where are they now, stress testing that if there was to be a change in rates, if there was to be a slight change in the market, where would we be looking at? And that sits alongside mortgage prices as well. We don't have crystal balls, so we can't put too much behind some of those, but I think a stress is the best way. If we were to downgrade the property value by a percentage and then also downgrade downgrade the leverage that we thought a bank was happy to go to, is it still going to work as an exit for us? Are we still going to get our money back?
Yeah, what you've just said there, that sort of resonates with me, because what we find sometimes is underwriters, they say, right, there's been a down val or something, so we're going to reduce the leverage on it. And it's like, well, there's been a down val, so why are you reducing the leverage as well? Why
as
why
well. Yeah, double
why are
whammy.
you moving the LTV down as well? Surely that's a double whammy. And we've had it with underwriters who have done that in the past, and we just don't understand why, because the market value is the market value. Why are you decreasing the loan to value as well?
Yeah, it's interesting, and I'll be very honest, it's something that we would do as well in certain scenarios. You know, if you are limited to a parameter, for example, say lots of lenders use 65% LTV as a bit of a standing parameter, that if the market value goes down, for most cases you want to stay at 65%, your loan amount goes down, but your leverage remains the same. However, if the feedback from the valuer, not just in numbers, but in their analysis, is that it's a weaker asset than originally considered. And, you know, we'd love to say that all of our initial due diligence avoids that, but there will be some cases where the asset's not as strong as it was considered, maybe the covenant on a lease isn't as strong as considered, and so we'll have to go back to our original risk assessment and say, actually, we prefer to be at 60% or closer to 60% LTV. Again, we always hope that we don't do that. We should be doing as much due diligence early on to avoid that. But sometimes the valuation isn't just the numbers, it's the analysis and the assessment they've given of the property, which also can pull up surprises sometimes.
And while we're talking about valuations, how many times have you seen a valuation be challenged and the valuer actually changed their mind? That's a loaded question, by the way.
Definition of challenged. Often we'll find that it's to do with information flow rather than anything. That it's not necessarily a challenge in that we disagree. It's that, oh, we didn't realise that this would have an impact on the valuation. Here we go, here's some additional documentation, or here's some additional information we failed to provide earlier. And it's not a failure by, it's more missing a piece of the jigsaw potentially. So really, I'd say that's the only time we see valuations change, is where there's additional information, say actually planning consents come through or variations come through subsequent to the valuation, that type of thing. We see happen. But no, it's good. It's a very good question. I'm trying to think if there's any other scenarios that really have played out in that way. I think, and this is the underwriting point overall, is that we're always happy to listen, and I think valuers are always happy to listen to borrowers, brokers like yourself, if you think that, if you truly believe that something is not reflected properly. However, it always comes back to that point of where is the evidence. We're always have to pick up the phone, listen to a point, really run through it in detail. But fundamentally, we're always going to need that substantiated in some way. So I have seen valuations change where that can be substantiated. I rarely see them change if there's nothing new.
Yep, good answer.
That makes sense. I guess it also depends on timelines, because if you've got a transaction that's taking quite a bit of time to get through to drawdown or to completion, you know, the macro environment could change. There could be a large ripple in the economy, something that happens that no one had seen. You know, we've had a few black swan events over the last couple of years. So things can change depending how long it takes. Roughly how long on average are you typically seeing your deals take to get to completion from origination?
Yeah, another good question, and again, probably quite seasonal. I mentioned auction finance earlier. You know, one of the transactions we completed in February, around 30 days. but that requires everyone pulling in the same direction with the deadline in mind. And I'd say some of the longest transactions can take 6 months, be it because of planning, legal issues, whereas on average, let's say 2 months, 2.5 months is probably a fair average of initial inquiry through to completion.
Yep.
Yeah, when I'm setting expectations for my customers, on the bridging side, I usually say 8 to 10 weeks. On the development side, I say 10 to 12. And for longer term debt, it's usually somewhere between 10 and 14. But our quickest completion's 5 days, and our longest completion is 3 years. So it's yeah,
Somewhere in the middle.
I think we had
Yeah.
a 5-dayer the other day in the office, and everyone was at their laptops pulling together. But yeah, I think most times we have a quick transaction. It'll be about 4 weeks,
Yeah.
and that it also requires a certain level of confidence. Often it's where the valuation is pretty watertight before they even go out. Obviously, we're looking to ensure there's no hidden surprises, but the valuer, a QS, a lawyer, all being instructed on the same day is something where we need quite confident borrowers. Often we'll see a timeline be impacted where a borrower wants to get the valuation back and reviewed before they'll instruct legals, QSs. So things can be strung out, not actually in a bad way, just by wanting to stack things one after another rather than piling on in.
And what you're saying there is completely correct. Sometimes the borrowers don't have confidence in their own deal themselves, so they do want to wait. And it's funny, when they first come on the phone and talk to us as brokers, they sell it to us as, oh, there's this brilliant deal, you should be doing it for no fee, and you should, get it through the system as quickly as possible. You're lucky to have this deal. But then they don't put the money where the mouth is a lot of the time. And yeah, it's interesting you say that.
Yeah, and that confidence can be, just not having a recent comparable. They may have come off a project that they last had value essentially 2 or 3 years ago, and this might be a similar project. They know they've got capacity to do it, but they want to get that RICS valuation in before they really commit to their next. And that RICS value will also be looking at the GDV, so they want a check and balance on their own forecasts and estimations.
Yeah, it's a sensible way to do it. It makes sense from a risk management perspective, but yeah, as you say, sometimes at the cost of time. But I totally get it.
Yeah.
Very good. Well, that's I think we're coming towards the end of this session. Have you got any sort of final tips for, I guess, for borrowers who are looking to work with Fiduciam, and how what they can do to best position themselves? There's a lot of generic tips that we've had on previous episodes as well, but anything that you think will help them to stand out amongst the other deals when you're going through your 5 a day to get the winners? What are your top tips for our investors and developers who are listening in on this?
And great question. I think it comes back down to the communication point. I think we, and I hope it's appreciated as a style of lending. We really like getting on the phone to borrowers. So whether it's through our BDMs and the relationship managers, or just calling someone up in the office, all our underwriters, all of our team are on the phone and ready to talk. And I think that talking things through early on, or asking for a group call saying, I'd like to meet the team who are going to be working my transaction. That's a great way, of us covering off lots of information in one go. It may be that we then, as I said, need it in writing later down the line, but it helps us to get a real feel for the transaction. It helps tee up site visits, just getting to know a bit more about the borrower, their story, why they're looking at a particular project. As I said, I've got some modern methods of construction. A lot of those are from an eco site. And when you complement a good project with real passion for a project, for example, from an environmental stance, it brings a lot of the story together very early in the transaction. And I think that adds a lot of momentum behind a transaction. It allows us to put together a lot of our questions in a much more thoughtful way as we go along. And from the other end of the spectrum, if there's any big issues, we are aware of them from the outset, and we can let you know if it's actually going to be a problem or if it's something that we can mitigate in several different ways, but we need to be working together to do that. So I'd say, in terms of borrowers interacting with us, interacting with lenders overall, is being prepared, having documentation is going to come up every time. A recent credit report or a certified passport can be as simple as that, through to picking up the phone and chatting things through. And you could get your architect onto that line, you could get your solicitor onto that line. Video calls are the norm now, and we'll complement that with site visits. But I'd say getting that in early makes the world of difference to transactions.
I really like that, and that openness to that communication, that makes a big difference. That's certainly something I probably need to get on the phone to you guys about as well at some point with my pipeline. But no, I really like that. That's really helpful. Any final questions for Louisa, Marc, from yourself?
No, fine. Everything that I've needed to ask has been answered very well.
Fantastic.
So thank you for that, Louisa. Really appreciate your time and coming on the podcast.
Yeah, no, it's been a fantastic episode. And if
Thank you
people
so
want to get in touch with you directly, Louisa, how would you suggest people can reach out or connect with you,
Yeah,
whether it's
absolutely.
LinkedIn or whatever?
Well, I was going to say, I think from a general standpoint, if there's no immediate transactions, you just want to know more about Fiduciam, what we do, then our LinkedIn's a great place to start. We keep a nice constant flow of the types of transactions that are completing, any events, networking, etc. we'd be attending. And it's hopefully just a good way of finding out more about us, keeping us in the background somewhere. Often, you don't want to wait until you actually need finance to go and be looking, and that's got great contact details for both brokers and borrowers to feed from. And other than that, always able to email me directly. I'm louisa@fiduciam.co.uk, nice and simple. And always able to pick up the phone to the office. And as I said, we can field those calls to the right person and hopefully have a bit of a chat straight away.
Fantastic. Well, that's really helpful. Louisa, thank you once again for such an insightful episode. Really enjoyed speaking to you today, and thank you once again.
Thank you so much. Thank you both.
Thank you.
That concludes another episode of Show Me the Money podcast, Unlocking Property Finance. Connect with us on social media, where we share additional tips, resources, and behind-the-scenes insights. Feel free to reach out to us with any questions or topics you'd like us to cover in future episodes. Until next time, keep exploring, keep learning, and keep making those smart investment moves. This has been Show Me the Money, Unlocking Property Finance.